So, let's talk about governments. Massive, complicated organizations. They collect money, mostly taxes. They then spend that money on all sorts of things. Roads, schools, hospitals, defense, a space program. But here's the multi-trillion-dollar question. How do we know they're spending our money well? How do we keep track of it all? You can't just ask the government for its bank statement. The system is way more complex than your personal finances. It involves countless departments, agencies, state-owned companies, all moving money in a giant, intricate dance. Enter IPSAS. IPSAS = International Public Sector Accounting Standards. Think of it as the official rulebook for government accounting, high-quality, independent standards telling public entities how to report financial info. The goal? Make government finances understandable, comparable, transparent. Without common rules, every country or department could count money its own way. That would be chaos. Imagine comparing two countries if one counts highways as assets and the other doesn't. Or one includes a state airline's debts and the other leaves them out. You'd be comparing apples to existential dread. You just can't do it. IPSAS gives a common language so citizens, investors, and international bodies like the World Bank can actually understand government reports. It creates a level playing field. And this brings us to Pakistan. Pakistan has been modernizing its public financial management. For decades, it used cash-based accounting, record money when it comes in and when it goes out. But cash accounting doesn't show the full picture. It misses long-term liabilities like pensions and long-term assets like infrastructure. So Pakistan launched a massive shift to accrual accounting under IPSAS. This isn't just technical. It's a fundamental change in how the government reports financial reality, aiming for greater accountability for all of us. Okay, we've established IPSAS is the big rulebook. A very, very big rulebook with many standards. Today, we zoom in on one standard. IPSAS 35, Consolidated Financial Statements. I know the name sounds dry, but stick with me. This one is a game changer. At its heart, IPSAS 35 is one idea. Present a government and all the entities it controls as a single economic entity. It's seeing the whole forest, not just a few trees. Think about a massive corporation like Disney, Marvel, Lucasfilm, Pixar, ESPN. When Disney reports earnings, it consolidates financials from all those companies into one report. That gives investors a complete picture. IPSAS 35 uses the same logic for the public sector. A government isn't just ministries. It often controls a network of organizations, state-owned enterprises, regulatory bodies, development authorities, public universities. IPSAS 35 sets out when and how a controlling entity, like Pakistan's federal government, must prepare consolidated financial statements. That means gathering financial data, assets, liabilities, revenues, expenses, and merging them together. Consolidation eliminates inter-entity transactions so you don't double count. Example: government grant to a state-owned university. Consolidation prevents it appearing as both a government expense and university revenue in the big report. The standard defines key terms and gives a step-by-step consolidation process. It makes us ask, does Pakistan control PIA? Does it control WAPDA? If yes, their successes, and more importantly their burdens, must appear in the government's main statements. This stops significant debts being hidden on separate books out of public view. It's about radical honesty in government finance. The whole universe of IPSAS 35 revolves around a single powerful word: control. But control in the public sector can be a bit squishy. It's not always as simple as owning more than 50% of the shares in a company. A government can exert control in many different ways, some of them less obvious than others. IPSAS 35 provides a very specific definition to help us figure this out. It says a government controls another entity if it has power over that entity, is exposed to variable benefits from its involvement, and can use its power to affect those benefits. First, power. The existing right to direct the relevant activities of the other entity. Relevant activities are the things that significantly affect the entity's outcomes. Setting its budget, appointing its key management, deciding its major policies. For instance, appointing the board of the National Highway Authority and approving its annual budget. Clear power. Power doesn't have to be exercised. Having the right is enough. Second, exposure to variable benefits. The government's outcomes can change based on the entity's performance. Benefits aren't always financial, often non-financial in the public sector. Example, control of a public health agency, improved public health outcomes. Example, efficient state-owned enterprise, cheap electricity, political and economic benefit. Conversely, massive losses, government exposed, bailouts. Finally, the government must have the ability to use its power to affect the benefits. Not enough to have power and exposure, it must be able to influence those benefits. For example, the government can direct a state-owned railway to expand service to a rural area. That directly affects connectivity for citizens, a key policy goal. Understanding this definition of control is the crucial first step for any government accountant in Pakistan compiling the big, consolidated report. Once a government entity in Pakistan, let's say the federal government, has gone through the painstaking process of identifying all the entities it controls, the real fun begins. It's time to actually create the consolidated financial statements. This isn't as simple as just adding up all the numbers in a giant spreadsheet. It's a meticulous procedure to present the entire group as if it were a single company. The goal is to show the government as a whole as it interacts with the rest of the world, not with itself. Combine line by line the assets, liabilities, equity, revenue, and expenses of the parent with those of its subsidiaries. Add the cash held by the Ministry of Finance to the cash held by, say, the Pakistan Television Corporation, assuming it's controlled. Two separate balance sheets slide together into one consolidated balance sheet. You'd add the government's buildings to PTV's buildings, the government's debt to PTV's debt, and so on. This creates a massive aggregated balance sheet and income statement. But the most important part is eliminating intra-group transactions. If the federal government gives a 10 billion rupee grant to a controlled authority, adding them would overstate expenses and revenues. From the perspective of the consolidated whole government, no actual transaction with the outside world occurred. Money just moved from one pocket to another. So, these internal transactions must be completely cancelled out. This same principle applies to assets and liabilities. If the government has a receivable of 5 billion rupees from a state-owned power company and it has a payable back, they cancel. The final report should only show what the group owes to external parties, like international banks, and what they owe to it. This provides a true and fair view, preventing artificial inflation of the government's financial footprint. It's a complex but essential puzzle for accountants to solve. So why go through all this trouble? Why has Pakistan invested so much time and effort into adopting IPSAS 35? The answer lies in the quest for transparency and better governance. For a long time, the true financial state of Pakistan's public sector was fragmented and opaque. The federal government's budget would tell one story, but it wouldn't include the enormous activities within state-owned enterprises. Many of these SOEs were accumulating vast amounts of debt: Pakistan International Airlines, Pakistan Steel Mills. These debts were often guaranteed by the government, contingent liabilities. If the SOE couldn't pay, the taxpayer would be on the hook. Yet these potential costs didn't always appear clearly on primary reports. Official debt figures looked better than the economic reality. IPSAS 35 directly confronts this. By forcing consolidation of controlled entities, it brings hidden liabilities into the light and onto the government's main balance sheet. When policymakers, international lenders like the IMF and World Bank, and credit rating agencies can see the entire picture, they make better decisions. It allows a more accurate assessment of fiscal risk. Are losses at state-owned power companies sustainable? What is the government's total exposure to its enterprises? IPSAS 35 moves decisions from guesswork to evidence-based analysis. Transparency is a powerful tool for public accountability. Poor performance is much harder to hide. Citizens can see the true cost of subsidizing inefficient enterprises. It creates pressure for reform, restructuring, better governance, even tough privatization decisions. In essence, Adopting IPSAS 35 is a commitment to a clearer, more honest mirror of the state's finances. Let's make this concrete. Imagine we are accountants for the finance division. Our task: prepare the first ever IPSAS 35 compliant consolidated statements. First, we need a list of all potential entities to consolidate. This list would be huge. Federal ministries, attached departments, subordinate offices, and many other bodies. Let's focus on WAPDA and the National Bank of Pakistan. For WAPDA, control is strong. Appointments, project approvals, tariff setting, and financial guarantees, aligned with core policy objectives. Success boosts growth. Losses may require bailouts. Therefore, WAPDA is consolidated. NBP is more nuanced. Majority ownership and appointments suggest control, but it's regulated as a commercial bank. Does the government direct policy lending? The answer determines control versus investment. For our example, assume it's controlled. Include WAPDA and NBP in consolidation with the federal government. Add up assets, cash, buildings, dams, loan portfolios. Add all liabilities, domestic and foreign debt, deposits, bonds. Then meticulously identify and eliminate intra-group transactions. For example, any deposits the federal government holds at NBP are eliminated. Any loans from NBP to the government are cancelled out. The final statement shows the combined assets and liabilities of the group, reflecting only its relationship with the rest of the world, not with itself. Adopting IPSAS 35 isn't a walk in the park. It's more like climbing K2. For Pakistan, the journey is fraught with significant challenges. First hurdle: data availability and quality. Statements may use different standards or arrive late. Many PSEs have weak reporting and delayed audits. You can't consolidate what you don't have. Second, capacity building. IPSAS 35 is demanding and needs a large cadre of skilled public sector accountants. They must understand consolidation and apply it in complex environments. This includes making difficult judgments about control and meticulously tracking eliminations. With a cash-based legacy, nationwide training has been monumental, from the Accountant General's Office to entity finance teams. Third, scope. The government controls a dizzying array of entities with different legal forms, governance, and purposes. Defining the reporting entity can be politically sensitive. Some may resist scrutiny. Finally, IT. Integrating legacy systems to share data reliably is costly and time-consuming. Despite the challenges, the benefits are transformative. The single most important benefit: dramatic transparency. For the first time, one set of statements shows the whole financial universe. Citizens, parliamentarians, journalists, and watchdogs no longer piece together dozens of reports. The consolidated report lays it all out, including state-owned giants once hidden in plain sight. Transparency fuels accountability. Big losses become impossible to ignore. It forces public conversation and policy action. Inside government, better data improves planning, risk assessment, debt management, and decisions on subsidies, guarantees, and investments. The Ministry of Finance acts like a true holding company over public assets and liabilities. Compliance boosts credibility, better ratings, lower borrowing costs, and greater investor confidence. It signals commitment to modern public financial management and global best practices. So let's wrap this up. Adopting IPSAS 35 is more than a technical exercise. It's a reform aimed at changing the culture of financial management, a shift away from opacity and fragmentation toward clarity and completeness. By requiring a single consolidated report that includes all entities under control, IPSAS 35 reveals the state's true economic reality. It brings hidden liabilities into the light and presents a holistic view of financial health. Yes, it's challenging. Overcoming old habits, building skills, upgrading IT, and navigating complexity. But the payoff is a government more transparent to its citizens and more accountable for performance. It empowers oversight, improves policy, enhances international standing, and builds trust. Better information leads to better scrutiny, governance, and outcomes for the people of Pakistan. IPSAS 35 is one standard, but a giant leap, a commitment to honesty in public accounting.